Alright, welcome back. We meet on the next clip, which is still in chapter 3. This is part 9, the ninth part of chapter 9 on financial analysis. So you were looking at interval ratio in the last clip. Okay, interval ratio, it measures the number of days operating expenses can be covered by current assets. Therefore, we take the total current assets. Okay, the formula for interval ratio is total current assets divided by the operating expenses. Operating expenses is taken from the income statement, which includes cost of goods sold and other expenses. You add these two, and then you multiply this with 365. Therefore, you get this value. So this is the formula. Okay. So we take total current assets divided by operating expenses. These operating expenses do not include the depreciation or amortization. Because this depreciation and amortization are not cash expenses. Operating expenses here include only cash expenses. Therefore, this gives you this value 211.2. So this unit is in number of days. So this tells you that the current assets that the company has can be used to pay for the operating expenses of the company for 211 days on average. So this is a measure of liquidity, how much cash can be used to pay for the operating expenditure of the company. So the greater this number means more liquidity. That means the company has more current assets that can be used to make this operating expenditure payments. Alright, so this is a measure of liquidity. So 211 is in the unit of days. 211 days. So how do you get this 211? This is simply a proportion. This is also a kind of proportion because the 365 days is equivalent to the expenditure. For example, here 206 plus 1740, this is the expenditure incurred by or paid by the firm or the company over 365 days, right? So how long or how many days can this current assets be used to pay for the operating expenditure? So if 365 days is equivalent to the total, the total of these two numbers, that is the operating expenditure. So what is the number of days for $2,168 dollars? So you just express this in terms of proportion. This is a proportion in number of days. So this 2,168 can be used for 211 days to pay for the operating expenditure. So it's a simple proportion formula. It's a proportion formula here. So that is the implication of this, the interval ratio. So it's also a measure of liquidity. Alright, so we have finished 5 ratios on the first category, which is liquidity and short-term solvency. Now we move on to the next leverage ratio. That's the next category. As we move down, this has been set as the header. So when you come to total debt ratio, it is not a liquidity ratio. It's a leverage or long-term solvency ratio. I've just set this as a header, so this does not change as we go down. As we move down, now this will show as if this debt equity ratio is actually liquidity. It is not. It is actually a leverage ratio or long-term solvency ratio. Now what is leverage or long-term solvency? It measures the degree of debt use or the ability to service debt. Ability to repay the debt or to pay interest on the debt on borrowing when the interest becomes due. So that is the measure of leverage or long-term solvency. So here you have several ratios. You have 6 ratios here. In the previous category, we had 5 ratios. So in this category, we have 6 ratios, 6 different ratios. The first one is total debt ratio. So total debt ratio measures debt as a proportion of total assets. Okay, so this reflects the amount of debt used to fund $1 of assets. So the formula for this is total debt divided by total assets. So both these numbers, okay, total debt and total assets, will be taken from the balance sheet. Okay, so total debt will be here. Okay, long-term debt plus total current liabilities. You can add these two, that will give you the total debt. Then you divide by total assets, 5606. You can either use this number or this number. They are the same number, 5606. Total liabilities and equity, or total assets. Now, so you get this value, okay, 50.62. This is expressed in percentage. Convention is to present this in percentage. So this is a proportion ratio. So how do you interpret this? So this means that, okay, 50.62% of the assets, the denominator, the assets are funded by debt or borrowing. Okay, so that's the idea. 50.62% of assets are funded by debt. Okay, so higher this ratio, then higher the use of debt. Okay, so that's the measure of leverage. How much debt, the degree of debt use, or borrowing. Alright, that's the first ratio. The second ratio is the debt equity ratio. This is also a very widely used ratio, and you will use this in the second course, which is Advanced Financial Management. It is less used here. Okay, we look at the debt equity ratio briefly, but this is not widely used in this course. But it will be useful for the next course, Advanced Financial Management. This measures the debt as a multiple of equity. It reflects the amount of debt backed by $1 of equity. So the formula for this is simple. This is just debt divided by equity. Total debt divided by total equity. So again, total debt is this plus this, total current liabilities plus long-term debt divided by total equity, which is 2768. So that's the value here. Okay, you can see the formula, B13 plus B14 divided by B15. So that's the answer here. Okay, the ratio is 1.03. Now this is in multiple form. So here, how do you interpret this? Okay, this is multiple, so it means that debt is 1.03 times the equity in 2018 for this company. So it also means that, okay, for every $1 of equity, the company has $1.03 of debt. Okay, so it uses slightly more debt than equity. So that's the idea here. So that is also reflected here, because the total debt ratio is more than 50%, more than half. Therefore, the debt equity ratio should be greater than 1. So these are all related. These two ratios are related. The numbers are different, but they represent the same thing, the same information, but it is presented differently. The number is different, but the information is the same. Right, then we come to the third ratio in this category, which is equity multiplier. Now, equity multiplier is also related to the debt equity ratio or total debt ratio. Equity multiplier, the formula is total assets divided by total equity. So it measures total assets as the multiple of equity. Reflects the amount of total assets funded by $1 of equity. That is the direct measure, but it also indirectly reflects the proportion of debt used by the company, or by the business. So here you take total assets, which is this 5606, divided by total equity 2768. So you get 2.03. 0.03. Yeah. Note that, okay, this equity multiplier must always be 1 plus the debt equity ratio. Why? Because the debt equity ratio, okay, means the proportion of the equity multiplier here is asset over equity. Yeah, this is debt over equity. So the other than debt, you have equity. Yeah, debt plus equity is equals to assets. Yeah, therefore, when you have assets divided by equity, it must always be 1 plus the debt over equity. Yeah, we can prove it using mathematically. Yeah, we can prove that this must always be 1 plus the debt equity ratio. The equity multiplier is always 1 plus the debt equity ratio. Yeah, so that is what you see here. Okay, it is 1 plus 1.03. Yeah, or if you take the figures here, total assets 5606 divided by 2768, you must get 2.03. Okay, so what does that mean? Yeah, what is the implication of this? Okay, it implies that the companies, here again, this is multiple. Yeah, so this describes the asset. Yeah, the asset of the company is 2.03 times. Yeah, a multiple of 2.03 times the equity. Right. So if it is 2.03 times, okay, one portion, yeah, only one unit is funded by equity, the remainder 1.03 must be funded by debt. Yeah, so again, all these three ratios, the numbers are different, but they actually reflect the same information of the company. Yeah, so it reflects the degree of debt use, yeah, the extent of borrowing or extent of loan used by the firm. Yeah, so higher this ratio, this will be higher, this will be higher. If this is higher, then these two ratios will also be higher. Lower these ratios, all three will be lower. Yeah, so that is how these three ratios will move together. Yeah, they are not independent, they are all dependent on one another. Alright, they are all interrelated. Yeah, they reflect the same thing. Yeah, okay, they are just presented differently. Yeah. Alright, now we come to the fourth ratio, which is long-term debt ratio. Yeah, long-term debt ratio is slightly different. We take only long-term debt. Yeah, we ignore the current liabilities. Yeah, so here the formula is long-term debt divided by the total of long-term debt and common equity. Yeah, why do we take these two? Because these two reflect long-term funds, or we call this capital. Long-term funds means capital. Yeah, this is short-term funds. Okay, total current liabilities will reflect short-term funds of the firm. Therefore, we ignore that and we just take the long-term funds, or we call this capital. Yeah, these two. So it is 843 divided by the sum of 843 and 2768. Yeah, so this is reflected as a proportion. Okay, as a percentage. So how do you interpret this? Okay, here it means that long-term debt, yeah, okay, is provides, yeah, or constitute or makes up. Yeah, here we can say make up because long-term debt is part of, yeah, the long-term funds or capital. Yeah, so here long-term debt makes up or provides 23.35% of capital used by the company in 2018. Okay, so that is what is reflected here. Yeah. All right. So these four ratios are all about the degree of debt use. Yeah, but this is only long-term debt as a proportion of capital used by the company. Yeah. All right. So the last two ratios here are about coverage ratios, and these are called coverage ratios. They don't reflect the extent of debt use. Yeah, but they reflect the ability to pay the interest or servicing the debt. Yeah? So here, the first ratio is called times interest earned, or TIE ratio. Yeah? This reflects the ability of the firm to use its earnings to pay interest. So the formula is EBIT divided by interest. Yeah, so we take that from the income